Well, a look at the Asian markets. There was a record close on Wall Street yesterday, as a result of which the Asian markets have started in the green in early trade, and that's primarily following hopes of a rate cut from across the central banks in the world globally. So we'll keep an eye out on the Nikkei, which is higher by about 0.4%, open slightly higher, but right now hovering around that 21,717 mark. Along with that, we have the Korean markets also sitting with 0.25% in green. The Straits as well as the Taiwanese indices, both of them should come up for you, both of them in the green as well by about 0.25% to about 1/3%. The SGX Nifty understandably indicating a mildly positive start, but again underperforming the global peers, but yesterday we did outperform them. So let's see how this pans out. Levels around that 11,950, 960 are finding some supply, and our markets ended closer to 11,900. Today is also the weekly options expiry, so in light of that, the last hour becomes very crucial.
Okay, so the Asian markets in the green on account of perhaps the record close that we saw on Wall Street. Remember, the US market closed early on account of Independence Day holiday, but major indices rose to record levels as investors cheered signs that global monetary policy will become more stimulative in the coming months. The Dow Jones gained around 180 points, notching intraday and closing all-time highs. The Nasdaq Composite and S&P 500 advanced 0.7%. CNBC's Bill Griffith gets us a wrap of all that transpired on Wall Street yesterday.
U.S. stocks finished the abbreviated trading day in the green. The Dow, the S&P, and the Nasdaq posted new record highs. Markets are closed, though, tomorrow for the 4th of July holiday. The Dow was up 179 points. The S&P added 22. The Nasdaq gained 61. June is shaping up to be another rough month for job growth. Private companies added just 102,000 new positions last month, according to data from ADP and Moody's Analytics. That fell short of expectations. This after job growth nearly ground to a halt in May. The labor market weakness, though, is the latest sign of a possible economic cool down. Meanwhile, Boeing is setting aside $100 million for the families and communities impacted by those two deadly 737 MAX crashes. The money is not part of any compensation the plane maker may have to pay to those who sue the company for damages. Boeing has been struggling to get that popular jet back in the air amid growing backlash over its design. And shares of Canopy Growth rebounded midday after shares originally sold off when the company said it would part ways with founder and co-CEO Bruce Linton. Linton told CNBC he did not resign. He was fired from the Canadian company. He said sometimes entrepreneurs are entrepreneurs because they're not super employable.
All right, and with that, just to quickly take you through the economic data released in the U.S., trade deficit jumped to a 5-month high in May as imports of goods increased. The trade deficit surged 8.5% to $55.5 billion, and this versus a forecast of the gap widening to $54 billion in May. Separately, much ahead of the anticipated government jobs report on Friday, private payrolls data from ADP showed an increase of 102,000 jobs in June versus expectations of 135,000. The disappointing data strengthens Fed's case for lowering interest rates at its monetary policy meeting at the end of this month. Meanwhile, a tweet from President Donald Trump calling for easier monetary policy added to the expectations of easier Fed policy. Trump said the U.S. should match monetary policies from China and Europe, noting they are playing big currency manipulation game and pumping money into their system in order to compete with the USA. Remember, just one day before this, Donald Trump had nominated 2 of his people on the board of the Fed as well.
Okay, on that note, let's hear out what experts make of the latest economic data coming out of US.
102 is the top line number. We saw weakness in construction and retailing, so we saw some outright job declines there. And the weakness across company sizes, it's really small businesses that are really taking it on the chin. Small businesses lost employment last month, and they've been struggling now for the past couple of years. The broader point, the economy's growth rate is significantly slowing. And I think the risks are rising that it's going to stall out. We're growing below potential. And if we stay here for much longer, unemployment is going to start to rise. If unemployment starts to rise, that will undermine confidence. And that's the fodder for an economic downturn.
We're going to get a little bit of a weaker number, and I'll tell you why. Because if you look at initial unemployment claims, those numbers have been going higher. So that really tells you that it's not just a supply, that the unemployment rate is so low they can't find workers. We're starting to see a little bit sluggish demand for workers. We know that the conference board's jobs plentiful minus jobs hard to get. That number popped down, the worst number, the biggest plunge we've seen in this expansion. So they're getting a little bit softer. On the wage numbers, we might see that number not as weak because there were less days in the month. And when you have less days and you take a monthly salary, that pushes the month-over-month number. So a little bit weaker, but stronger than last month. I'm looking for about 140,000.
We're looking for 140,000 job gains on Friday, which would be better than the ADP, a little bit below consensus. But I think, the main message here is if you look at jobless claims, you look at ADP, you look at the recent payrolls, is that job growth has been slowing, but it's not collapsing, which is what we expect to see continue on Friday.
There is this so-called positive convexity in bonds where yields could collapse towards 0% in a recession because the Federal Reserve more than likely will commit to keeping its policy rate low until the jobs rate falls back when it rises again toward the 4% level it considers full employment. That could take up to 5 years before that happens and inflation rises. So in other words, the Fed's policy rate will probably be around 0 up to 5 years after a recession hits. And so this will mean the bond market will pin most yields out to 5 years near 0 and other yields close to it. And so there is still a lot of room for U.S. Treasury yields to decline. But again, don't try to market time the diversification benefits of bonds. It's very risky considering the other components in an investment portfolio.
And across the Atlantic, European markets closed higher on Christine Lagarde's nomination as the next ECB chief. Eurozone bond yields stumbled on the news and defensive stocks rallied as investors bet that the incoming head of the ECB will favor low interest rates. Financials also did well, and in Germany, particularly Deutsche Bank was higher by almost 3% on reports that they are talking to Citigroup and BNP Paribas for a possible deal.
Okay, let's shift focus now to the world of currency. The dollar is range-bound, trading near a one-week low versus the yen as falling treasury yields fueled expectations that the U.S. Federal Reserve will cut interest rates this month for the first time in a decade.
In the world of commodities, crude oil prices bounce after yesterday's sell-off, but still trades weak around that $63.50 per barrel mark.
Okay, it's time now for a quick break on the show. Up next, we'll get you all the cues and news you need to know for trade this morning. Stay tuned.